Welcome to the summary of Lecture 13. In this lecture, ICT teaches us how to read order flow effectively, offering valuable insights into price delivery continuum theory. If you want to learn how to read the order flow correctly, make sure you watch the video till the end. There are some golden nuggets in the end, which will make you confident in holding the trades. These advanced concepts will help you gain a deeper understanding of how the market moves and how to anticipate its next steps. Be sure to like the video, leave a comment with your feedback, and check the description for the PDF notes. Let's jump right in. In the last lecture 12, we've analyzed the price action, where the sell-side imbalance and buy-side inefficiency have been fully mitigated, leading to 8 consecutive bullish candles. Our focus now shifts to this volume imbalance on the chart. In today's session, we are observing price action on August 20th, starting right at the 9:30 a.m. open. The price gapped down during the regular trading hours, while in the electronic trading hours, we can see relative equal highs and a new day opening gap from today. ICT is focusing on the new day opening gap and anticipates that this gap will act as a magnet for the price. ICT shifted to the 15-second chart and pointed out that when a specific candle formed, the price should not break below the consequent encroachment of the wick. He expected the price to deliver up to the new day opening gap, and he instructed the audience to take a screenshot of this setup, as it was a significant teaching moment. For those traders without a solid trading model, ICT emphasized that this setup could serve as a standalone model. If there's a new day opening gap acting as a draw on liquidity, and we have relative highs or lows in place, it could work as a trading framework. He clarified that the new day opening gap doesn't have to be from the current day. It can be from any day within the last 5 days, or even a new week opening gap. The key principle is that price should not drop below the consequent encroachment of the identified wick. ICT stressed that this approach is very interesting and recommended backtesting it. This setup could yield quick positive outcome, either hitting the take profit target or the stop loss relatively swiftly. This setup has really intrigued me, and when I have the time, I plan to do some backtesting and share my findings with you all. However, I can't promise when that will be. With these summaries, ICT's live lectures, and my own trading, I'm not getting much time. Plus, I still need to deliver the PDF, but organizing everything has been a challenge. In the last few lectures, ICT shared some important nuances about this setup. When we're bullish and there's a clear draw on liquidity on the other side of the gap, there's a 70% chance that 50% of the gap will be filled. You can take this information and test it for yourself. Personally, I enjoy this style of trading where you don't have to wait too long for results. ICT revisited a key point from his previous summary, a volume imbalance near the closing price that the market had approached but not yet touched. In today's London session, price traded into that area. He pointed out that when we apply a quadrant to this level, we see that the upper quarter hasn't been touched. However, price beautifully closed within the third quadrant, which indicates a possible draw on liquidity that is fresh, and price may attempt to reach that level. From the third quadrant, price dropped down toward the new day opening gap. At this point, ICT divided the last quadrant of the volume imbalance into 2 more pieces, as he needed that additional information. His initial draw today was on the remaining portion of the gap, but he cautioned that it didn't mean price had to go up there immediately. Price could deviate from expectations, and it's crucial to remain patient, waiting for a clear setup. Moving forward, ICT noted that the line below the lower quadrant of the volume imbalance was the upper band of a sell-side imbalance and buy-side inefficiency, and price was hovering around this level. At this juncture, it was essential to analyze whether the algorithm was trying to deliver price to the fresh imbalance. ICT then identified a very significant bullish order flow signature. There was a gap on the 15-second chart and another gap on the 1-minute chart. The 15-second gap was situated in the upper portion of the 1-minute fair value gap. As price reached the first quadrant of the volume imbalance, another signature emerged. ICT advised placing a Fibonacci retracement on the wick, highlighting how price barely touched the consequent encroachment of the wick before advancing to the first quadrant. This method of reading order flow from the candles is, according to ICT, the essence of his price delivery continuum theory. It involves analyzing naked price action and does not require the use of depth of market or level 2 data. The logic derived from reading these price signatures is sufficient. After price tapped into the fair value gap, it began to climb. ICT then suggested that we should consider taking partial profits before reaching the terminus, as price had already reversed once from the third quadrant. And there was a chance it could do the same again, attacking the sell side and hitting the stops of traders who were trailing their stop losses. As price retraced back to the fair value gap, ICT stressed the importance of reflecting on the session's learnings. He advised traders to take screenshots of the significant price signatures and to continuously review these points on their charts. ICT emphasized that even while tape reading, it's critical to spot these signatures and ideas, screenshot them, and then observe how price behaves afterward. This practice is essential for mastering the skill of trading. He encouraged traders to embrace the hard work that most people avoid, as this dedication sets successful traders apart from the majority. ICT then reminded us that while we may anticipate price to go higher, it is not guaranteed that it will do so immediately. Therefore, it's important to lock in profits along the way by taking partials. This method is generally more effective than trailing stop losses, especially for newer traders. ICT also provided valuable insights into price gaps. He emphasized the importance of marking the 50% level of any significant gap. The gap should be sizable, not a small one, ideally more than 25 to 30 handles. If you're backtesting the 50% reversal model, the length of the gap is a key factor to take into account. In most cases, price will only fill half of the gap before reversing. This midpoint level is often where price retraces before quickly moving in the opposite direction. And ICT suggested using this concept for bread and butter setups. ICT clarified that when a gap fully fills and we expect the price to continue in that direction, we must observe how price behaves relative to the gap. If price breaks through the upper band of the gap and respects it, bullish order flow should be confirmed. In today's example, the new day opening gap was the critical reference point. Price closed in the upper portion of the gap and later retested it. ICT also pointed out an institutional order flow entry drill that occurred. One of the key lessons here was that although price displayed several bullish order flow signatures, traders must remember that it is not always guaranteed to reach the final target or terminus. As a result, taking partial profits along the way is crucial. To conclude, ICT urged traders to maintain focus on determining where price is likely headed, but to also remember that outcomes are never guaranteed. The key to successful trading is managing the trade effectively. Now, you might be wondering how to confirm if the order flow is truly bullish. When price breaks from a gap, observe how the candles behave. If the candles approach the gap but don't close inside it, and instead hover around and close above the gap, it's a strong sign. After this, if price rallies, breaks the new week opening gap, comes back to retest, and breaks a swing high, then taps into a fair value gap. The past signature shows that price is coming to fair value gap to continue rally. It's clear the order flow is bullish. One key factor in recognizing order flow is how the candle bodies are closing. Pay close attention to that. There's no guarantee when it comes to price delivery. Even if you've marked everything correctly and entered the trade perfectly, the outcome isn't guaranteed. As you can see here, the price completely reversed and dropped to the gap low. To survive in the market, it's essential to take partial profits as part of your trading plan. I hope you found the insights on order flow and price delivery useful for refining your trading skills. Don't forget to like the video, share your feedback in the comments, and check the description for the PDF notes. Your support is always appreciated. I'll see you in the next video. Happy trading! Thank you all for watching the summary of Lecture 13.